kick off, thank you guys for joining us today. Today we're continuing our webinar series on crowdfunding topics. I'm glad you can make it with us. And we have with us today two gentlemen from the company called Navocate. Both Carl Buell and Boaz Vinogradov are going to lead a discussion today on business valuations and setting share price for crowdfunding deals. I met Carl and Boaz at the recent crowdfunding conference in Las Vegas and was impressed with their presentation and their approach to setting valuations and talking about the dynamics of doing so. Carl comes from a background with General Mills, Pillsbury, and was a Microsoft executive. And Boaz comes from a technology background, also with medical device companies. But without further ado, I'll pass it over to them, and we'll have them lead us through the discussion. They'll have a presentation for about 30-35 minutes, and then we'll have Q&A. You have a box down there called questions, so when a question occurs to you, go ahead and fill that out and put that question in there. And when we get to the question section, I'll read those out, and we'll have Carl and Boaz put them out there for answers. So with that, Carl, I'll go and pass it to you.
Excellent. Paul, thank you very much, and thank you everyone who is participating today on this webinar. We appreciate the opportunity to do this. We really enjoyed our time in Las Vegas at the crowdfunding boot camp. We had a breakout session there where we talked about crowdfunding valuations and setting share price. So what you're going to see today is a variation of that. So let's just go ahead and jump into this. My name is Carl Buell. I'm the managing member of Navocate. That's my smiling face there on the right. And as Hall indicated, my first career, I'm a second-generation madman. Worked in Chicago in account management for several large ad agencies, working on accounts like General Mills, Pillsbury, Wrigley, and McDonald's. Great training ground to learn strategy for both packaged goods and service businesses at the Fortune 500 level. And then in 1982, I moved out to Seattle, worked for a couple of small agencies, which really wasn't very interesting, but then started my own consulting business and ended up doing some consulting work for Microsoft, and they hired me. I worked at the executive level during the explosive growth period of 1990 through 97 is when I was there. Also on the line today, we have Boaz Vinogradov. Boaz is my business partner in the business. He's a former president and CEO of several tech companies and medical device companies, as Hall indicated. He has grown startups from scratch to 30 to 100 million in sales and has participated from the inside on 3 IPO exits through NASDAQ and the Swiss Stock Exchange. I will be doing the presenting today, and Boaz will join us for Q&A. So with that, let's talk about the topics we're going to cover today. We're going to talk about why business valuations for crowdfunding are relatively unique, and we're going to talk about business valuation resources available in the marketplace today. What resources are out there and how are suited or not suited for crowdfunding. We'll talk about the relative costs and timing and why most of these resources aren't really optimal for crowdfunding. We'll talk a little bit about our crowdfunding valuation model that we're making available and will be available for businesses that need to get crowdfunded through one of the portals. And then we'll talk about setting share price. And then, as Hall indicated, open it up. We'll try to get this done in 20, 30 minutes so we can open this up for questioning. We like to start by just talking a little bit about Navocate, not to sell you anything, but to give you an idea of who we are, where we are in the marketplace, and how we fit. This is a matrix we're going to show you here that shows different company sizes and what intermediaries serve those different companies. So let me see if I can grab a little pointer here. So we start out with the large corporations. We define those as $100 million plus. These are publicly held companies. They have corporate hierarchy. They're national and international in scope and scale. and those are the focus point of the Wall Street investment banks like Morgan Stanley and Goldman Sachs. After we have the Wall Street investment banks, what comes next in the hierarchy is a range of boutique investment banks. The higher or upper echelon of those boutique investment banks cover the middle market. And the middle market really has no particular definition in terms of revenue scale. We define it as 50 to 150. It can certainly go higher, it can go lower. These tend to be public or private companies, but they also tend to be well-organized companies that have a corporate hierarchy. The smaller boutique investment banks service the lower middle market companies, which can range from 10 million, 15 million on the bottom end to 50 million or more on the higher end. We define those as developing organizations. These are generally privately held companies as opposed to the middle market companies that can be publicly held. At the bottom, you have Main Street companies. We define Main Street companies as companies with less than $1 million in revenue, although if you looked at it statistically, you would find that most of those companies that sell in the Main Street area are probably selling for under $100,000 or $150,000. The Main Street companies tend to be privately held and very proprietorship in nature, and again, this is the realm of the business brokers. Where Navocate works is what we call this intermediate layer here that we call entrepreneurial companies. We define this as about $3 million on the low end, about $30 million on the high end, can go higher, certainly $50 million perhaps, but they tend to cluster in this $3 to $30 million range. These are privately held companies that are very entrepreneurial in nature. So let me, let's see here. Let's erase all the ink on the slide and go back to the arrow. Now the reason this positioning is important is because the investment banks have a cultural and financial floor. They generally don't go down below their threshold because the deal size is too small, but also because from a cultural standpoint, it's really difficult for an investment bank to work with a highly entrepreneurial company. There are many reasons for that. We can debate whether that's true or not, but we generally find that to be true in the marketplace. The business brokers certainly would love to go up, but many, many business brokers have a capability ceiling in that they don't understand or know how to bring investment banking techniques to these entrepreneurial companies. The business broker approach tends to be the real estate approach, and that's how they're licensed. There are about 12 to 15 states in the United States that require licensing for someone to sell a business. Florida is one of those states. Texas is not one of those states. So you can actually sell a business in Texas without having a real estate license. Of course, if real estate is a component of the sale, then of course you do have to have a license. So this middle range entrepreneurial set of companies is where we work and where we have our experience. So we do an extensive amount of work working with entrepreneurs on the buy side and the sell side, and over the last 4 years or so, we've created our own proprietary business model, valuation model, for figuring out how to value these companies. And we're adapting that valuation model to crowdfunding, and the legacy history of the model, where it's come from, is what we'll be talking about, as well as how we're changing it for crowdfunding. So key point here in telling you all of this is to help you understand our background, help you understand that we work intensively with these entrepreneurial companies, and we're approaching this from a business standpoint more than we are a theoretical valuation standpoint. Let's go into crowdfunding valuation. The starting point is the bill, the jobs bill that was passed and signed by President Obama last April. And there's a provision in there, and if you wanted to look it up, that's the section, but the provision is that a crowdfunding issuer who offers securities shall file with the Commission, that's the Securities and Exchange Commission, and make available to potential investors how the securities are being offered and valued. So there's a lot of information in this provision here. What it says is that an issuer or someone who's crowdfunding and issuing securities needs to tell the Commission, how are you offering and valuing those securities? Well, most entrepreneurs, particularly at the low end and particularly those who are in the startup phase, don't come from a finance background. So in order to figure out how the securities are being valued, you have to figure out how the company is being valued. So there are two modules there that are fairly complex for somebody who doesn't necessarily understand that or has not necessarily done that before. So that's the nature of what we're doing here to fill in. We'll talk about, as we talk about valuation, you really, with any valuation, you have to start very clearly by understanding what are the objectives. What is the purpose of this valuation to start with? Who is the audience? How will this valuation be used? And what are the usage requirements, including things like, is this valuation going to be used for regulatory compliance, for legal documentation, for litigation support, for crowdfunding? Depending on what the specific requirements are, it tells you how the valuation needs to be developed, what kind of support and background support materials and information needs to go into the valuation in order to make sure that the valuation is focused very specifically on its intended use and the audience. Now this is, when we get into looking at certified appraisers, for example, if a certified appraiser develops a valuation, and let's say it's for none of these. Let's say you want it for a bank loan. Or let's say you start with it's an internal use to help the owners of the company understand what the value is, but we're going to transcend from this internal use to a bank loan. You cannot take the valuation developed here and just simply hand it over to the bank. It needs to be repurposed, and again, I'm talking about certified appraisers, and how they repurpose it is they actually charge more money and they take a little bit more time to go through that process of repurposing it. But the point of this slide is simply to say you have to be very clear about the objectives before you go down the road of producing the valuation. What we're going to talk about now are the different valuation resources available in the marketplace. We're going to do that by defining a table here. The Y1 axis on the left talks about cost from little to a lot. The X-axis focuses on preparation and detail, less to more. And the Y2 axis talks about time running or spanning from days to weeks. As you use this convention to define the different types of valuation resources out there, you find that it segments into different kinds of uses. On the left-hand side, low cost, low time, less preparation, less detail tends to be used primarily internally. As you get up to the middle range, now we have external use where you have medium cost, medium time, and medium preparation and detail, and then the third segmentation is litigation on the right, which requires much more time, money, and detail. So let's populate this table now that we understand the conventions here. At the lower left of the scale, you have online valuation, which has developed as a resource over the past 3 to 5 or more years, and this is, again, very low cost, very quick timing, and it tends to work like you put your information into the online questionnaire, and you get a FedEx report 3 to 5 days later. What's missing from that is a lot of interaction and the opportunity to go into specific detail and specific circumstances. In the middle range, the primary resource there is the certified appraiser. Certified appraiser is going to run, say, $5,000, $6,000 on the low end to maybe around $8,000 to $10,000 on the high end. It's going to take 6 to 8 weeks, so a long time, fair amount of money, and now we are able to have an appraisal that's used for loan substantiation. This is pretty much how anybody wants to get a loan through a community bank or the SBA or a large regional bank, whatever it may be, you need to work with the certified appraiser. The way Navocate is positioning is underneath this cost and underneath this timing, we are, again for crowdfunding, providing our valuations ranging from $500 to $2,500 depending on what stage the company is at. For example, if it's a pre-revenue company, we're only going to charge $500 for that. If it's a revenue company without profitability, our charge is $1,000, and for a revenue company with profitability, the upper end of that rate is $2,500. The timing is 1 to 4 weeks, and we're aiming for 2, but we're saying it could take up to 4 depending. On the right side of the scale, and I'll go through this relatively quickly because it's not germane to crowdfunding, but it's interesting to know as a data point, you have litigation support for appraisals, and that really segments into 2 different subsegments. You have an amicable litigation situation, you have a hostile litigation situation. Amicable is we're going to divide the company, but we have to go through some litigation to do that, but we're reasonably well attuned to each other. It's going to cost maybe $10,000 to $12,000 a day for the appraiser, $350 an hour plus travel. High-end hostile support is going to be approximately the same, but you're going to have a higher cost there. And the reason for that is that if you have a certified appraiser who needs to sit in front of a judge and jury, he or she needs to know exactly what's going on and what they're going to be saying. There's a lot more preparation time involved in that. So that talks about the different resources available and where Navocate is positioning on that scale. So basically it comes down to a company I worked for out in on the West Coast for a while had this sign in their elevator. It was speed, price, quality, pick any two, and you've probably seen that before. But the point is, this goes back to the 2 slides ago, where you really need to define the purpose of the valuation. And for crowdfunding, most of the providers are agreeing that it needs to be reasonably low cost. So you've got to have that price in there, but certainly good quality for the SEC and the portals that are putting together the actual offering. So let's take a few minutes now. We'll talk about Navocate's valuation model. We actually have prepared and designed this model for 3 business stages. The first stage is the pre-revenue stage, where you have a concept. It's a business startup. You have a business plan. You have pro formas. Crowdfunding is going to see many of those situations. How do you value that company? Well, that's something that we have taken a look at based on our experience and have developed a model around a pre-revenue company. You also then have a second stage company where you have revenue but no profit. When anybody launches a company, there's going to be a period there, perhaps up to 1, 2, 3 years or even longer, where the company is not going to be making any money and getting to that break-even point where they can achieve profitability. And then, of course, you have the third level, which is what we all aspire to, which is revenue with profit. In addition to those 3 different company phases, we conduct 3 different levels of analysis. We do the what's called the sell side, we do the buy side, and we do our own soft side. And I'll talk a little bit about each of these right now. The sell side looks at the question, how have similar companies sold in the marketplace? Well, because we have a price point and a timing point that's relatively quick and very low cost, we're not doing specific comps for every business. We look at a database that we subscribe to of approximately 700 different industries. And we know from that database throughout the United States how different businesses have sold in that industry. Another thing that is looked at, obviously, is asset value, and we can add that into the equation if we have that information, but we do not provide a valuation or an appraisal of assets. The reason for that is assets really bifurcate into two different kinds of assets. The most prevalent type of asset that a business would have is real estate. And as you all know, real estate is a local market, local business. An appraiser who looks at a warehouse in San Diego and also looks at the same size warehouse in Dallas is going to come up with different conclusions because those are different markets with different trends. So we don't try to do that. Another class of asset is obviously furniture, fixtures, and equipment. Let's say that warehouse now has manufacturing equipment in it. That manufacturing equipment really needs to be valued and appraised by an expert who understands that specific type of manufacturing equipment. So for an example here, we sold a business several years ago that had very specialized equipment. The bank flew in an appraiser from California to Florida to appraise that equipment. So that's why we don't try to appraise those assets. It's very highly specialized. However, if you have those asset values, we can fold those into the model. Now, based on the database and how your particular business fits in the 700 industries here, we actually do some sensitivity analysis where we're looking at the range of how those businesses have sold. And I think that's another point of difference between a certified appraiser. A certified appraiser will tell you that your business is worth $1,295,324, and actually they say 7 cents. I always like to see the 7 cents in there. We're looking for a range of value in the marketplace, so we run some sensitivity analysis to understand that. So that defines the sell side. Several years ago, we learned some very interesting things about looking at the sell side only. We realized we needed to take a hard look at the buy side. And the reason you have to look very hard at the buy side is because you have to understand the deal structure. The deal structure is defined by the buyer. Some buyers like high risk and high leverage. Other buyers like low risk and no leverage. The amount of risk in the deal, the amount of capital in the deal, the amount of financing in the deal has a direct bearing on what the debt service is. Different levels of debt service are going to have an impact on the value of the business. So the buyer actually can influence the price of the business. So we look at the deal structure, and then we run some projections to model what we think the ideal buyer is going to look at, and we run multiple deal-based combinations to understand how the range of different deals can impact the value of the business. So when you look here at both the buy side and the sell side, it's actually, remember the old teeter-totter days, it's a little bit of a teeter-totter, because you may have a high value when you look at the sell side and a low value when you look at the buy side. You may have a low value on the sell side, but your buy side analysis tells you that business could be valued higher. So that's why we look at both the sell side and the buy side. Then we started overlaying some things that we call the soft side. And our certified appraiser brethren don't really look at this. This comes from our business background, individually and collectively, looking at things like the management structure of that company. How deep is it? How broad is it? How experienced are they? Do they have financial controls? Do they use those financial controls to manage the business? How often do they do that? What's the scope and scale of the market opportunity? Is this biotechnology or nanotechnology, which has the capacity for explosive growth, or is this the construction industry that can be highly cyclical? What kind of process and systems and procedures does this company have in place? Or is it, if you look at management and systems, is it a traditional entrepreneurial spoken wheel management system where the entrepreneur is in the center and instructions are yelled to the outside? All of these things have significant impact on the business's ability to succeed and grow. And then, of course, we look at risk factors, which can include internal risk, external risk, and legal risk. So we look at all of these things across 3 different stages of companies: pre-revenue, revenue with and without profit. We essentially cover all of the cells in this matrix and are able to gauge a business and value a business with the sell side, buy side, and soft side analysis that we do. One more slide here, actually 2 more slides, and then I'll open it up for questions. How do you then look at and analyze share price across different sizes of companies, different stages of companies? So with the pre-revenue company, obviously you don't have much to work with except pro formas. The more pro formas you work with, the higher the risk you have in the model. Looking at revenue with profit, or I'm sorry, without profit, we have a little more information. We have revenue to work with. You can do a discounted cash flow, but certainly you have no information to work with of any kind that has to do with profit or profitability. Lastly, we have revenue with profit, and that's, again, where we all aspire. And across the bottom here, you can see now we have a full range of reliable information from which to develop the share price models. So this is the type of information that feeds into the share price modules in our model. And then, in addition to this, we also look at similar factors that we do in our soft side analysis. We look at how explosive is the category, or how static is the category. Is it an early stage company? Has the company been around for a long period of time? We look at all of those things to determine what the discount rate is in another set of modules to determine the share price after we have the valuation. Wow, so that's a lot of information very quickly at a very, very high level. I'm going to stop and say, just pause here and say, so why Navocate Valuations? We bring the history and background and the experience of business sales and acquisitions with entrepreneurial companies, the management team's business development history. We have experience with government affairs directly, which allows us to understand how to work with the SEC, understanding that the SEC is going to be changing this target over time. So you need a company that's able to adapt to and understand what those changes are. We have a lot of experience in the equity markets. We're working with venture capital and private equity valuations have been constructed based on all of those things coming full circle, and all of that experience has been folded into our valuation model. So enough said. Let's open it up, Paul, for Q&A.
Okay, we've had several questions come in. The first one is, how do you see valuations in crowdfunding? How do they compare to angel deals?
Sure. Well, it's a very interesting question. Angel, and Paul, you may be best suited to answer that because you're an angel guy, aren't you?
Yes, and so we see angel deals being done all the time, and there's a certain level and approach to it. And then I guess the question goes to how do you think crowdfunding, the new model there is going to impact valuations, or have you seen any impact where they're coming in higher than angel or lower than angel out there?
I think, well, first, not enough data to answer the question, because crowdfunding for non-accredited investors, the law is in review with the Securities and Exchange Commission. We are supposed to have a verdict within the next several months such that a decision will be made and crowdfunding can start first quarter of 2013. But without the SEC's review, we really haven't started this process yet for non-accredited investors. I think the key difference is going to be with an angel. Let's see, let's use this to draw. You have your angels up here, and how do you know they're an angel? They have these wings. Does that look like you, Hall?
No, just exactly.
Okay, so we have the angels over here, and then we have crowdfunding here. Well, the SEC is involved in, as you can see from the statement at the beginning, the SEC requires that the issuer define how the securities are being valued, which requires that you define how the company is being valued. Certainly, the angels are going to want to know those same things, but you're not issuing stock to an angel, so it's a different type of investment. The angels are certainly going to look at the financials, but they're not necessarily needing to run the same type of in-depth analysis that the SEC is going to require for an issuer. So it's a bit of an apples and oranges comparison. Where I'm getting to there is the angels, I think, are going to make a lot of determination based on their experience and their gut feel. Boaz, are you on? Do you have an opinion on this?
No, you're doing well.
Okay, I'm doing well. So let's hope that answered the question to some degree, and Paul, maybe go to the next question.
Okay, well, the next question had to do with what do you see in the Jobs Act as far as the laws shaping up? Do you see any interim feedback from the SEC about what they're going to do with this situation?
Yeah, good question. If you go to the SEC site, you can look and see they have some information there about the Jobs Act specifically, as well as their schedule for when they are reviewing the law at different stages. And I believe there's something coming up here over the next several weeks. So that's your best resource to understand where the SEC is in its process. And by the way, when they have a review session, you can actually dial in and participate in terms of listening and watching it on video on your computer. So that's the best way to stay informed there. I would say from the provider side, providers being companies like us, providers being the portals themselves, we have a strategic relationship with a company called Early Shares in Miami. That is a portal. Like Kickstarter, for example, we have a strategic relationship with a company called CrowdCheck that's going to be providing information for due diligence. All of those companies if January 1st is the date, and you have all these providers out here like this, all of these companies are getting ready, but I would say they're not quite ready yet. So I think, you know, a lot of things should shape up, and we should get clarity and focus around first quarter of 2013. I don't know that the SEC will be at a point where they will have blessed it, but hopefully the end of Q1, sometime Q2 2013, we should see deals hopefully start to flow.
Right. So the next question is, once a valuation is set, what can be done to change it, or you know, do you have to redo the entire valuation, or is it a formula that you just redo?
Good question. Well, for us, it's relatively, for us, let me answer the question straightforward. It's relatively simple to work with the issuer or the owners of the company and take different or revised assumptions, plug those into our model, and provide a separate report which will have separate results. We haven't priced different iterations into our model. Our model is, or our pricing is basically, you provide us with a set of assumptions. We'll do this within 2 to 4 weeks, and you will get the result out. We do not, and we say this in our marketing materials and our contractual agreement, we do not provide any assessment as to the validity of your assumptions. We can certainly do that, but that is more of a consulting relationship. We certainly have that flexibility, but it's above and beyond the stock pricing that we have seen there, or we have shown you. And if you don't want the consulting, but you say, hey, I'd like to run several other ranges of assumptions, yes, we can do that very, very easily, because while the model itself is very complex between the consolidated income and the sell-side analysis, the buy-side analysis, the soft-side analysis, and the stock module analyses, our Excel model is 20 or so tabs. So the model is very, very complex, but we keep a snapshot of what the model looks like when we issue the report, and we can go back and certainly do variations on the theme. We haven't figured out exactly what the cost of doing that is yet, but we certainly will.
If I may expand a bit, it really is an issue of what kind of change you want to make. I'll give you an example. Changes that reduce your risk will take a turnaround of in the same day. Example, you provided us with the financials that came from an Excel sheet or are homemade on a in-house software. That's one level of certainty in the financials. You go and you get an audited by a CPA. Now the certainty of the accuracy of your financials go up from a buyer perspective, and it improves your valuation by some element. Similarly, if you had a risk of a lawsuit against you, and that lawsuit has been resolved, or a judge decided in your favor, that's going to substantially reduce your risk. Other things that are a little more difficult to deal with are, for example, you've limited yourself to a single market with the service or product that you are going to deliver. Through the process of the fundraising, you came across, and full time, you came across another application that is relatively easy to add, but takes you to another marketplace. And so if you used to be B2B, and now you are adding B2C, or alternatively, your customer base were companies with a technological need that you provide a solution to, but are usually above the 100 million, and suddenly you realize that you can deliver it to the mom and pop shops, which open a substantial local market for yourself. How is that? What's the risk level in this market? How volatile it is? we can add it relatively easy. To finish the analysis of it will require you to answer additional questions than just letting us know that you're making that change. And that may take a day or two to go through and reflect it correctly in a model, and obviously change to the valuation, which may add, again, reduce risk, because you are dealing with two markets, and value is always opportunity versus cost of the opportunity versus the risk in the opportunity. And so it's balancing those three that you are trying to make sure you looked at all the facets before you give somebody an idea we think the value changed and the new value is.
Well, as you reminded me of something I should have mentioned, which is the SEC with the Crowdfunding Act has a threshold, and I don't know if I'm quoting this correctly, but you can look it up in the bill. If your business is $500,000 or more, you must have audited financials. Audited financials, if I can spell. If it's less than 500, I think your accountant has to sign off on it. So whatever financials you're providing, it has to have some degree of external review. This is one reason that we had a big debate about how much hand-holding do we provide to a new entrepreneur in terms of helping them with a pro forma. We ultimately decided not to do it at all because these checks are in place. And again, Hall, as we had mentioned, if somebody wants us to help consult, we can certainly help do that. But if you have a $500,000 business, your financials must be audited, which is an extra expense and requires some additional time.
Right. The next question is, they say they're using a equity-based crowdfunding site in Europe. How does valuations come into it in international crowdfunding sites?
Wow. I cannot answer that question, and I'm not going to try because I haven't looked at that information. Boaz, do you have any experience there?
With crowdfunding, very little, but I suspect it will be very similar to, for an American company, it will remain very similar. Okay.
Next one is, it says, I need funding to build a bowling anchored family entertainment center. Will crowdfunding work for that type of need? And the next one says, I need $7.5 million or a 504B loan with qualified investors. Any comments about that?
Sure. Let's take the first question. The great thing about crowdfunding, from my perspective, and I think Boaz shares this as well, is that it frees up much needed capital for entrepreneurs and startup businesses. We're in a situation today in the capital markets where we have had so much increasing regulation over time. You know, the regulation goes up and just continues to go up, and what that tends to do is, while it drives risk down for the investors, it increases the costs for the entities providing that capital. So your regulation is going up, your costs go up as a result of that, the cost of capital goes up, and now we have a market where the economy, which was doing really well here, is now doing well here. We have a delta between the cost of capital, the availability capital, and the amount of business flowing in the marketplace. So the reason crowdfunding is potentially a great solution for that is because it represents a relaxation of the securities and exchange laws. So we have angels in place. They serve a role for very, very early stage. You know how it goes. It's friends, family, and credit cards. Then it goes to angels. Then you might qualify for venture capital. Rare that a company will qualify for that. And then private equity comes in at a later stage when you've got customers and revenue. Without crowdfunding, well, let me flip that. With crowdfunding, you now have a lot of extra capital available in the marketplace. Now, this is a marketplace. So if you have a product or service, no matter what it is, you now are able to go out to non-accredited investors and certainly to accredited investors as well and pitch your business, pitch your opportunity, and see if they want to invest in your company. So it becomes more of an open marketplace as opposed to a accredited marketplace. There is no barrier on ideas or industries or whatever the barriers might be. So I think crowdfunding is a great opportunity for businesses at all stages to go to the markets and get some capital. When we say all stages, we mean things like you have a bakery in Kansas City, Missouri, and your bakery bakes things, and all of a sudden now you need a whole lot of new equipment that you can't afford. That can be a crowdfunded solution, so it's not just for startups. Now, the question regarding credited or accredited investors, I don't think we know how this is going to play out yet. We do expect the existing Series 24 broker-dealers to certainly get involved in crowdfunding. The existing broker-dealers are, have a good line to accredited investors. And so we're going to see crowdfunding techniques be made available for accredited investors for larger investments. Keep in mind that the SEC for crowdfunding has put a cap on it of $1 million. And I wish Paul, who was with our office, was on this call. He could tell you what that time frame is. I believe it's a year. But
yes, Carl,
yeah.
It's $1 million a year, every year. So the question about the $7.5 million crowdfunding would not be the best place to go because you cannot raise $7.5 million in one go. But if $1 million helps you push your product service to the next level and getting another million or going for a different type of financing in the next step, would be much easier. Another thing that crowdfunding does, which is important for those that $1 million would be enough, crowdfunding issues common stock. Private equity, venture capital, and angels like to deal with preferred stock, and rarely do they go for common stock. Preferred stock stands in the way of the next investor. As much as the institutional investors that like to get preferred stock would tell you that it doesn't, having gone using venture capital and angel money public 3 times, when we needed mezzanine funding, the VC agreements were in our way because banks would not agree to it, and the VCs make it difficult to agree that they will be second collector after the bank gets the money first on the loan. So crowdfunding simplifies by many ways. Again, for those that are seeing $1 million a year as sufficient, simplifies greatly the exchange of capital with the company. And that is a great credit to that establishment, because it evens out the play field and attracts investors that are looking at a lower risk again, because now you're not signing a deal with a or few angels or one venture capital. You have 500 or 800 investors, each putting $1,000, and thereby not risking substantial enough money to want and deserve specialized conditions on their stock.
Guys, those are all the questions that have come in. If anybody else has a question, go ahead and type it in now. We've gone through the list that's come up so far. While we're waiting to see if any more questions come in, Carl, Boaz, do you have any final comments before we go ahead and close it out for the day?
I would just reiterate what I said a few minutes ago, that I think crowdfunding as a resource of capital to non-accredited investors could be potentially huge for this country, and we really need it right now because our capital markets are locked up, and it's ultra difficult for companies at the lower end of the range, whether they're startups or pre-revenue or even revenue generating but just on the growth curve, ultra hard for them to find capital. We're really looking forward to it, and we've been working in concert with some of the other companies in this industry to help develop the industry and make sure it does get developed. I'd like to really compliment Ruth Hedges, for example, with Crowdfunding Roadmap and the people she's been working with. 18 months ago, 2 years ago, they were talking about this and decided they needed to get an act of Congress passed to get this changed to enable capital for crowdfunding. They did that in less than 18 months. It's a phenomenal change. It's the first substantive change to the securities laws in approximately 80 years. It has enormous potential. We're all very excited about it.
Well, that's great. Well, I want to thank you guys for joining us today. Appreciate the information you've shared with our group. We will put the slides up on the webinar site for the Texas Entrepreneur Network, so those who want a copy of it, you can go back to the site where you registered and you can actually download those slides. I'll have that up end of today as well. Thank you, Carl. Thank you, Boaz. And with that, we'll go ahead and close it out for now.